Good morning, friends. Now we will start the Unit 4 of your syllabus, discussion on the Unit 4 of your syllabus, non-banking financial companies. See, in a banking and financial services subject, in the first part, we have seen the banking sector related discussions. What is a bank? What are the different types of banks, commercial banks, and in that commercial banks functions, Reserve Bank of India functions, and even merchant banking activities and all that. Now, as a financial services part, non-banking financial companies are also playing a very pivotal role in providing the financial services. What are these non-banking financial companies? Right? How different types of non-banking financial companies, the regulatory framework, all that related things we need to discuss here. Mere banking companies are not sufficient to meet the needs of the finance in the country because banking activities are very limited in our country. The limited banks are unable to provide services to the corporate sector to a fullest extent because much of the banking services are for the individuals or for the small investors and all that. Banking companies provide much of the services to small investors and provides loans and advances to small buyers of loans. It is not able to these companies. There are only few banks which are uh, giant banks providing the financial services to corporates. So the demand of the capital in the country is so big that the existing banking institutions are unable to meet the need of the corporates' financial requirements. Therefore, some non-banking financial companies came into existence without doing a banking activity but acts like a bankers who provides the loans and advances, such companies are uh, allowed to operate in the country by the government and Reserve Bank of India and all the regulating authorities in order to help the development of the uh, industries, development of the agriculture, and development of various sectors. The basic idea behind establishing or allowing these non-banking financial companies is to uh, uh, is to support the financial requirement along with the banking sector. So non-banking financial companies play a very pivotal role in meeting the needs of the financial requirement of the corporates and even some small companies. So, what are these non-banking financial companies? Let us discuss. In this discussion, in this unit, we are trying to discuss the non-banking financial company and overview, meaning, role, differences between the non-banking company, types of the non-banking financial companies in India, regulatory framework, microfinance models, services, challenges of non-banking financial companies, leasing and hire purchase concept, types, evaluation, problems in evaluation of leasing and hire purchases. So these are the things that we are going to study in this model. But in the first instance, we will discuss all the theoretical aspects relating to the non-banking financial companies. The second part of this non-banking financial company subject is fourth unit is the evaluation of leasing and hire purchase concept. Leasing and hire purchase concept. So there are certain problems which are normally asked in the examinations. So we will deal with the problems after the completion of the whole theoretical discussions. So now let us understand in this first lecture series meaning of non-banking financial companies, differences between banking and non-banking financial companies, then role of non-banking financial companies, types and all that. First one is, what is non-banking financial company? Non-banking financial company is the company registered under the Companies Act of 1956. Remember, all the banks are registered under the Reserve Bank of India Act, under the Act of Reserve Bank of India, 1934 Reserve Bank of India Act. But these non-banking financial companies are registered under the Companies Act of 1956 or 2013. It is a revised, what you call as a amended Act of Companies Act in the year 2013. And it is engaged in the business of loans, advances, acquisition of shares, stock, bonds, debentures, securities issued by the government or local authority, or other securities of like marketable nature, leasing, hire purchase, insurance business, chit fund business, etc. So these non-banking financial institutions are basically engaged in providing the loans, advances, acquiring the shares of some companies, stocks, bonds, and debentures of companies. Because whenever the stocks and bonds are issued by the companies, these non-banking financial institutions will invest money and hold the shares and stocks. It is a type of supporting the capital requirement of the companies. So they are bound to purchase the stocks, bonds, and debentures issued by the government, local authority, or even the private companies, etc. And these non-banking financial services also includes a hire purchase and leasing and insurance business, etc. So these are the institutions engaged in providing the financial support to the government or to the industry or to the corporations. A non-banking financial institution, which is a company and which has its principal business of receiving deposits under any scheme or arrangement or any other manner or leading in any manner, is also non-banking financial company. What we call as residuary non-banking company. There are certain companies which are called as residuary non-banking financial companies. They are authorized to receive the deposits in uh, uh, any scheme, in the sense that they can develop a certain schemes of receiving the deposits from the public, and the deposited money they can utilize it for giving the loans and advances or lending like a banking organization. But what is the basic uh, difference between the non-banking and banking companies? See, basically, bank is defined as per the Banking Regulation Act of 1949 as an institution established for the purpose of receiving deposits. Established to receive the deposits for the purpose of lending. The deposits are taken in four basic forms that we have already discussed while discussing the banking discussion lectures, where there are four important deposits that a banker can receive. One is called as a savings bank account in the form of SB account, and the second one is in the form of a current account. Third one is in the form of fixed deposit, and fourth one is in the form of recurring deposit. Any bank which is operating under the Reserve Bank of India Act of 1934 are allowed to take the deposits of these four, wherein the savings bank account and the current accounts are operated through issuing using the checks, and check comes under the Negotiable Instrument Act, right? Negotiable Instrument Act. So only the banking companies are allowed to accept the checks and repay the deposits to their clients, to their customers. So this kind of repayment is possible through check systems and all that. So non-banking financial companies may take a deposits but cannot take the savings bank account or current account deposits which are operated through issuing the checks. That is the basic difference between non-banking financial companies and the banking companies. Banking companies will normally prepare their own capital out of the deposits that they receive from the public, and the received deposits are issued to the customers as loans and advances. Whereas non-banking financial companies will have their own share capital or debenture capital, where out of that capital they issue the loans and advances to their customers. That is a one more basic difference. The capital formation of a banking company normally happens, majority of the capital formation happens out of the deposits in case of banking organization, whereas in case of non-banking organization the majority of the uh, capital collected through issuing the shares and debentures to the public, and out of that collected public the money will be utilized for the loans and advances of their business. So this is what the basic differences between the banking and non-banking industry. So how we define the banking? Banking banker is the one who accepts the deposits for the purpose of issuing loans, whereas non-banking institution is a company which may or may not accept the deposits but issue the loans and advances to their customers with the purpose of earning the profits or with the purpose of helping the industry or the sectors. If you see the basic differences with the points, you will understand completely what is non-banking financial company is. The basic difference is, in case of banking, banker accepts the deposits withdrawable by check or demand. In case of withdrawals, sometimes we may even use the withdrawal slips, which is called as demand withdrawals. But non-banking financial companies cannot accept demand deposits and use the checks. Non-banking companies carrying the financial business, they may issue the loans and advances, but they may not take the deposits, especially savings bank and what you call as current account deposits. Scope of the business, if you consider scope of the business of bank is limited by section 16 and subsection 1 of Banking Regulation Act of 1949, because these banks cannot raise the capital from the outside public for the purpose of issuing loans and advances to abundant way. Therefore, the banking company's operations are limited to the level of the deposits that they collect from the investors, that we call as customers. So bank cannot go beyond the limits of these deposit abilities to provide the loans and advances. The more the deposits, the more the activities. But normally the banking deposits are regulated by the Reserve Bank of India Act. But in case of non-banking financial companies, there is no bar on carrying activity than financial, other than financial activity. So they can avail huge abundant of capital from the public if there is a need of the financial requirement, that is loans and advances, and meet those loans and advances requirements by issuing the shares, collecting in the form of mutual funds, like that. So they may go for the such kind of things, but bankers cannot. Major limitation on the business, if you see, non-banking activity are carried even by banks. Bankers carry non-banking financial activity such as bills receivables, discounting the bills receivables, then acting as a security for the factoring activity, like the security for the deposits and all that, or giving the what you call as a guarantee of their result, providing the loans and advances for buying the vehicles and all that. So these are non-banking activities they can get indulged into to certain extent. If the capital available, if the deposits available are sufficient, they may undertake these activities. But if you see the non-banking financial companies, they cannot provide checking facilities or time deposit acceptance, savings deposits and all that. They have to concentrate only on the non-banking activity. They cannot do a banking activity. If you see the foreign investments in establishing the banking sector and non-banking sector, in case of banking sector, any foreign company is investing, the maximum investment ceiling is 74.4%. What is a foreign investor? Any foreign company wanted to invest in our banking business, maximum ceiling is 74%, right? The remaining part of 26% is to be invested by the Indian banking activity and banking company. So then only the banking things will come under the control of Reserve Bank of India. But in case of non-banking business, 100% of the investments can be made and foreign non-banking companies can be established in our country. Then need for a license. License norms are highly controlled and generally it is perceived to be quite difficult to get a license for a banking activity. For a banking activity, licensing is more what you call stringent. So Reserve Bank of India reserves the maximum rights, and if at all any bank's performance goes below the level and does not meet the expectation of the Reserve Bank of India at any point of time, license can be withdrawn. This is basically because banking works on the trust of the deposit holders. So therefore, in order to protect the interest of the deposit holders, bankers cannot behave as per their whims and fancies. They must and should come under the control of Reserve Bank of India. Therefore, licensing norms are the controllable tools. Whereas in case of non-banking financial companies, it is comparatively much easier to get the registration as a non-banking financial companies because it comes under the Companies Regulation Act, Companies Act of 1956. So that is how the flexibility in getting the permissions and licenses. Establishing a bank is difficult, whereas establishing the non-banking financial companies much easier. If you see the regulations, Banking Reserve Banking Regulation Act (RBI) Act laid down on the stringent control over the bank, whereas non-banking companies are much easier control over the non-banking because Securities Exchange Board of India, then Companies Act of 1956, and the government of Karnataka, government of India contract laws and rules will be applicable for this non-banking financial companies, but they are not so stringent in the regulating the activity. If you see the role of non-banking financial companies, even if there are banking institutions in our country, why do non-banking financial corporations are gaining so much importance? Because of their basic role. One is the first role that they play, non-banking financial companies, are the development of sectors like transportation, infrastructure, etc., where there is a dearth of capital. They supply the capital, and because of that, transportation industry and infrastructure industry is developing in our country. Like for example, the Life Insurance Corporation of India provides more what you call as support for transportation business and for housing loans and all that. It provides the capital because it collects the funds in the form of what you call as premium from the public. It does not take any deposits. The collection of money will be made in the form of premium. Premium is not a deposit, and out of that collected premium, it it is going to invest that collected premium in the form of what you call as supporting the loans and advances for the companies. And it undertakes the risk factor, but the possibility of the risk in the death of the people and all that is low. So when it is having a corpus fund in its hand, it provides the loans and advances for infrastructure development and all that. So therefore, a lot of companies emerge because of easy capital available through non-banking financial companies. So it helps for the growth of industrial sector in our country. Second one is employment generation. As you know, these non-banking financial companies provide a maximum employment opportunities to the youth. And because of providing the loans and advances to the industry, also employment generation is happening. It is indirectly, it is helping for wealth creation in the country. Wealth creation is creating the assets in the country. If the good roads are developed, it is an asset. Good roads are assets. Utilizing the what you call as barren lands and converting them into good agricultural uh, sectors or developing the forest. So all this increases the wealth of the nation. So NABARD, National Bank for Rural and Agricultural Development Banks and all that, they are the non-banking financial institutions, provide loans for irrigation purposes, provides loans for what you call as agro-based industries and all that. Because of that, wealth creation is happening. If you see, the economic development is also the result of non-banking financial corporations efforts. So economic development normal happens when there is a good production activity happens in the country, and the demand happens basically because of increasing the income of the public. So economic development happens. So non-banking financial corporations are helping for all this. Then if you see the financing weaker section, easy financing is possible through non-banking financial corporations because they have more flexibility in issuing the loans and advances as compared to banking sectors. Because in case of banking loans and advances, they have to strictly follow the stringent rules and regulations of the Banking Regulation Act. Whereas in case of non-banking financial corporations, they do not much uh, follow the problems, the rules and regulations for issuing. Any party who can repay the money, and if it is found feasible, non-banking financial corporations will easily sanction the money. But where in case of banking organization sanctioning the loan, will look into the asset acquiring and all that, surety and all these kind of stringent rules are there. Whereas in this case, it is so easy. Therefore, weaker section who can easily avail the financial support from this non-banking financial corporations. The major thirst of the non-banking financial corporations on semi and urban rural areas has really provided the developmental activities in rural and urban areas. Whereas the banking activities mainly concentrating on urban and major cities, but the rural areas requirement of the loan is neglected to a larger extent. Therefore, under cooperative systems and all that, these non-banking financial organizations, credit organizations which are established by the self-help groups are developing a lot. So therefore, non-banking financial organizations are helping for development of rural areas more than the banking sector. So if you see the types of the non-banking financial corporations, basically these are the various non-banking financial corporations who are classified based on the objective for which they are established. Objective for which they are established. The purpose of non-banking financial corporations only classifies them into various categories. So now we have a broad category of around 8 types of non-banking financial companies, and any financial company will fit into any of these kind of these things. Let us discuss one by one. The first one is mutual benefit financial companies, what we call as nidhi companies, and we have investment companies, commercial equipment finance companies, hire purchase companies, loan companies, residuary non-banking companies, housing financing companies, and factoring companies. Let us discuss one by one in detail. Mutual benefit financial companies, also called as nidhis, are the non-banking financial companies that enables its members to pool their money with a predetermined investment objective. The main source of the funds are the share capital, deposits from its members, deposits from the general public, etc. See, these are nidhi companies. What they do is they collect the money from the public in the form of issuing the mutual funds, or in the form of what you call as deposits, not that deposits which the banks takes. It will take certain kinds of deposits or installment kind of deposits from the public, and that pooled fund is being used for investing in the big company shares and stocks. So it is going to help mutually for the industries which are coming with the capital requirements, demand for capital requirements, and the people who are having a limited amount of capital in their hands. It pulls the investments from the public and provides the huge financial requirement to the company. That is called as mutual finance companies. If you see the Tata Mutual Fund, Nippon Mutual Fund, and all that, so what these companies do, they collect the investments from the public, institutional or even individuals. They can invest money in the form of mutual funds. Mutual funds are the funds small collected from the people and made a corpus fund, and that corpus fund is being invested in the share market. The volatility of the share market is understood, and the investment is made by these fund agency, non-banking companies, in such a way that there should be profit, and the profit is shared with the investors also. Now investors are relieved from the market fluctuations because of lack of knowledge of the stock market. They cannot directly invest money in the stock markets, therefore they prefer to invest it through mutual benefit companies. So it is fantastically working in our country. There are a lot of companies working in the mutual fund sector. Then investment companies, the basic objective of these companies is to provide investments to the new companies. Their basic idea is to increase the investments of the deposit holders. An investment company is a corporation or a trust engaged in the business of investing the pooled capital of the investors in financial sectors like Wells Fargo Financial, AIG Capital. Their main purpose is to create the capital out of the investments and investing that capital in the industrial sector. They is called as investment. The objective is to invest money in the companies by creating an investment option to the public. Then we have commercial equipment finance companies. These are the financial, non-banking financial companies who provides the loans and advances for commercial equipments, for acquiring the auto, or for acquiring the commercial vehicles for transportation business, or for providing the equipments which are necessary for production and all that. So their basic idea is to help their clients to purchase the equipments for their business purposes, that is to earn the profit. So this helps for increasing the entrepreneurial development in the country. For example, the Sundaram Finance Company, Cholamandalam, Magna Equipment Companies, and all that, these industries are providing the financial services to many of the equipment purchase requirements of the companies. We have hire purchase and leasing companies. Here, these are the companies which are providing for the huge, big uh, uh, assets, to purchase the huge, big assets. Like for example, if the assets value is in crores, normally an industry which wants to buy that asset may not be able to invest so big money. In that case, these financial companies will buy the assets in their name and provide it on lease basis to the companies. So lease during this time, the the uh, the leasing company, what you call as a financial company, buys the assets in its name and transfers it to the users called the clients. So the user company will use that machine and pay that installment basis every year or every quarterly to this finance company. At the end of the term, say for example it is for 10 years, after the 10 year of paying the money, the asset will become the ownership will be the asset will be returned to the company, that is the non-banking financial company. Here the asset possession will transfer, but the ownership lies with the company only. That is called leasing activity. For that leasing activity, financial companies will buy the assets in their name and use it for using it to the business people. And after the completion of the lease period, the asset will be returned back to the company, that is non-bank financial company. The financial company will sell it out and reimburse the final installment. Or in other hand, there is one more contract called a hire purchase. In this case, the asset will be acquired by the industry uh, by taking the loan from the financial company. In this case, the financial company will provide the loans and to the assets which is purchased. But normally the asset is in the name of the financial company, and it is used by uh, the purchasing company, asset purchasing company. After that particular usage of time, when the last installment is paid, in case of hire purchase, the assets rights transfer from the financial company, non-banking financial company, to its purchasing client. The best example is buying the two-wheeler, four-wheelers on loan basis. In this case, the non-banking financial companies provide the loans to the client. After the last installment is paid, the ownership will be with the buyer of the vehicle. That is how the things happen. So we have very good examples of Bajaj Finance providing auto loans and all that, Sriram Transportation Finance, etc. And there are many other international renowned foreign companies providing hire purchase and leasing loans and advances in our country. Then we have one more called as loan company. These non-banking financial companies provide specific sector-related loans like industrial development for the purpose of developing industry, industrial development bank of India, institutional industrial credit and investment corporation of India, ICICI and IDBI. They are specifically meant for providing the loans and advances to industrial development, where we have national so we have agricultural bank, that is National Bank for Rural and Agriculture and Rural Development, that is NABARD for agriculture and rural development, etc. NABARD is also non-banking financial organization. There are many agro-based agricultural financial uh, institutions established for providing it to agriculture. We have fisheries related development boards, fisheries boards, whose main purpose is to provide loans and advances for developing the fishery industry. So sectoral based loan companies, their main purpose is to provide the loans and advances to develop that particular sectors. So there are many loan companies in our country. Then we have residuary non-banking companies. These are the non-banking financial institutions who look like a bank, who take the deposits from the public, but they do not provide, they do not take the time deposit, the savings bank and current account deposits, except that different types of deposits are taken by them, and they provide the loans and advances to their clients in any way they want. An example is the best example is your postal department. Postal Department is a residuary non-banking financial companies. It is not under the Banking Regulation Act, but it is under the Postal Regulation Act, comes under the Companies Act of 1956, is the public sector organization. The Postal Department is also getting the deposits from the public in the form of what you call as in the form of deposits like recurring deposit, time deposits, and all that, but they do not allow the checks to be utilized for withdrawing the money. Checks are not utilized, but they will give the transfer to their accounts based on the indent of the customer. But these postal departments are also providing loans and advances to the needy industrialists or needy people, even for construction of house and all that. So this is what the residuary non-banking company. They look like a non-banking organization, but they are not banking organizations. Only the difference is they do not come under the Reserve Bank of India control fully. But they need the Reserve Bank of India permission to start because they are taking deposits. So Reserve Bank of India regulates them, but not Banking Regulation Act is applicable to these organizations. Like we have chip fund, provident fund companies, state finance companies, etc. Even the finance provident fund companies are also doing the same thing. They collect the money from the people in the form of deposits, but after the particular expiry of the time during the retirement and all that, the provident company funds will be given to them. So, but they are not the as well as banking organizations. Then housing finance companies, the companies which are basically established for providing the home loans to the industries or to the individual people in the country. Diwan Housing, Griha Finance, Home Loan companies, etc. They provide not only the loan facility, not only for constructing the house, but also for real estate businesses, for buying the what is it, for buying the plots or for buying the construction grounds for the purpose also is providing. Now we have the last one called as factoring companies. A factoring company specializes in invoice factoring or purchasing outstanding. These are the financial organizations who help to those companies whose debt recovery is very slow. Debt recovery is very slow. If the company's debts recovery is very slow, many a time that debt is the rights of the debt is transferred to these factoring companies. The factoring companies will purchase those debts called as non slow performing assets uh, and provide the money to them. And these companies which get the loans out of that will be easily using it for the smooth functioning of the business. That is what we call as factoring companies. Normally, the bills receivables are 30 to 90 days, but there are certain companies which cannot wait for 30 to 90 days. So, therefore, these companies will sell these, they deposit these kind of bills receivables to the factoring companies. So, factoring companies supply the funds immediately and recover that money from the debtors in future days. It's in a slow installments and all that. These companies are called as factoring companies. So we have a lot of factoring companies which are indulge in factoring activity, like India Factoring and Finance Solutions Private Limited, SBI Factors and Commercial Services Private Limited. We have even Canara Bank engaged in factoring services called as CanBank Factoring Services. So these factoring companies will help the industries to liquidate their what do you call as non-performing assets at a very early age and early stage and collect the money for the smooth functioning of their business. So industries engaged in this activity are called as non-banking financial factoring companies. So here we will end our discussion. In the next subsequent things, we will study the other aspects such as regulating regulatory authorities working on the non-banking financial companies. So we will see the remaining aspects in the next lecture. Thank you. Thank you.